Good morning or good afternoon, everyone, depending on what time zone you're in. My name is Mindy Gare, and I am the Southeast Region Business Development Manager for the Entrust Group, and I will be one of your hosts for the webinar. During this webinar today, we are going to discuss some of the basics of self-directed IRAs and the benefits of utilizing self-directed accounts. And then I'm going to turn it over to my co-host, Chris Benson, who is the Chief Investment Officer at Reliant Real Estate Management, who is going to discuss how the self-storage industry works. We hope that y'all find the information presented today on this webinar valuable and educational. Everyone is going to be on mute, but if you have questions as we go through the presentation, please feel free to go ahead and type those questions in the Q&A box on your GoToWebinar dashboard, and we will answer those questions during the live Q&A at the end. Also, after the webinar, we will be providing audio recordings of this webinar to everyone. All right, before we get started, I have a quick disclaimer. The Entrust Group does not provide investment advice, tax advice, or legal advice. So we're not CPAs, attorneys, or financial advisors. We do not recommend or endorse any investments, products, or services. And the information in this presentation is for educational purposes only. We do, however, recommend that you seek investment advice, tax advice, and legal advice before entering into any investment. The agenda for the webinar will entail a quick and brief overview of self-directed IRA basics, an overview of the self-storage space and how this type of asset has performed during the pandemic, trends for future growth, and the risks associated with self-storage. Again, we will open it up for live Q&A at the end, so please feel free to go ahead and start typing your questions in the Q&A box as we go through this presentation. All right, I want to share a little background on myself. So as I mentioned earlier, my name is Mindy Gare, and I'm the Southeast Region Business Development Manager for the Entrust Group. I've been with Entrust for almost 4 years now, and prior to joining Entrust, I worked for several years in the retirement space. My main focus is working primarily with individual alternative asset investors, investment sponsors, issuers, so basically any company raising capital. I work with a lot of CPAs, attorneys, and advisors who are diversifying their clients' retirement portfolios with alternative assets. And I work out of our Nashville, Tennessee office. For those of you who are not already familiar with Entrust, we are self-directed IRA record keepers and custodians who specialize in holding alternative assets inside of retirement accounts for our clients. And we have been doing this for almost 40 years. We have around 22,000 accounts, and that holds roughly $4 billion in investor assets. And one factor that makes Entrust unique is our single point of contact business model that we offer our partners and clients when they open an account with us. And we do this because we understand that this area of business is much more complex than the traditional market. So we like to provide a higher level of customer service to our clients and partners. Most of our staff here at Entrust hold the CISP designation, which is Certified IRA Services Professional. We offer national continuing education classes for realtors and CPAs. We hold national and local events and webinars. And we also sponsor an IRA Academy, which is where we actually teach the course that trains other people in our industry to pass the CISP course. All right, for anyone who is not already familiar with self-directed IRAs, they are a retirement account in which the individual investor is in charge of making all investment decisions. A self-directed IRA provides the investor with greater opportunity for asset diversification outside of the traditional market of stocks, bonds, mutual funds. So, for example, you can invest in assets like real estate, private tax liens, notes. All of those can be purchased inside of a self-directed IRA, and I'll go into a little more detail on the different asset classes in a little bit. Now, in order to invest in these alternatives inside of your IRA, all securities and investments must be held in an account administered by a custodian or trustee who's willing to hold these types of assets. So not just any custodian will hold alternatives. It's a very niche market, so only certain custodians will hold the actual alternatives inside of an IRA. And they do the record keeping and reporting to the IRS. All right, now let's quickly discuss some of the benefits of having a self-directed IRA. The first benefit is that you are able to take control of your retirement. So you make all of your investment decisions, meaning you have complete control over what you are investing in. So this allows you to further diversify your retirement portfolio and allows you to invest in assets that you know and understand and know the types of risks and returns that are associated with those investments. So you as the account owner are your own fiduciary. Another benefit is the potential tax savings using a self-directed IRA. So contributions to your account might be tax deductible, and earnings can grow tax deferred or tax free depending on the type of account that you have. All right, what types of accounts can be self-directed? Well, here at Entrust, we actually have 7 different types of accounts that are self-directed. 4 of those accounts are individual plans. So those 4 plans are traditional IRA, Roth IRA, an HSA, which is a health savings account, and an ESA, which is an education savings account. All of these accounts have the exact same characteristics and eligibility as your standard type of account. It's just that our plans allow you to self-direct the types of assets. Then we have 3 plans for small businesses. These plans are employer-sponsored plans. We have individual 401ks, a simple IRA, which is a savings incentive match plan for employees, and a SEP IRA, which is a simplified employee pension IRA. So again, all of these 7 plans are self-directed accounts, and you can invest in any of the alternatives inside of those 7 plans. Now let's review what you cannot invest in. So the Internal Revenue Code 4975 has basically 3 restrictions that you are not allowed to invest in inside of your self-directed IRA. Life insurance, collectibles, and S corporations. That's the 3 things that you are not allowed to invest in inside of a self-directed IRA. There is one exception to that, and you can invest in gold, silver, platinum, and palladium bullion of certain purity. Those are allowable investments. All right, now that you know what you can invest in, what you can't invest in, let's also talk about who you cannot do business with. So one critical aspect in determining whether a transaction inside of a self-directed IRA is going to be allowed or prohibited is understanding who a disqualified person is. Very important that when you're in the self-directed space that you know who a disqualified person is. So a disqualified person is going to be yourself, your spouse, your lineal ascendants, descendants, and their spouses. So your parents, your grandparents, your great-grandparents, so on up the tree, their spouses, your children, your grandchildren, your great-grandchildren, their spouses, financial advisors, managers, beneficiaries, or any entity where you or a disqualified person have 50% or more ownership. Those are all considered to be disqualified persons. So what that means is at no point are you ever allowed to buy, sell, transfer ownership, or provide goods or services between your IRA and a disqualified person. Now there is one exception to that, and that exception is that you can partner with a disqualified person at the initiation of the purchase. So that is the only time that your IRA is ever allowed to do business with a disqualified person. Otherwise, absolutely not at all. All right, and that was my quick and very brief overview of self-directed IRAs, and that concludes my portion of the webinar. Now I'm going to turn it over to the Chief Investment Officer of Reliant Real Estate Management, Chris Benson, to share his expertise on investing in self-storage real estate. Again, as a reminder, As you have questions, please go ahead and type those in the Q&A box on your GoToWebinar dashboard. And after Chris's presentation, we will answer those questions.
Well, I appreciate it, Mindy. Thank you so much. And I think what's in front of you right now is a poll that you guys can fill out right now, just to give us a sense of, what level of information you have in regards to the asset class of self-storage, so that we can get a sense of, have you been experienced in investing in self-storage in the past? Is this a new asset class for you? Where do you stand? So I know the Entrust team right now is putting a poll out in front of you. So if you could click on that, that would be great. And it'll give us just a good sense of where you sit as a audience. I think that will, you should be in good shape there on the poll side of things. So Andrew's going to share the poll results with the audience here. So it looks like 59% of you not very familiar with self-storage. They're here to start learning about it. That's great. So the majority of you. 31% I know an average amount. I know a little bit about it, but want to learn more. And then 10% very experienced, currently investing in self-storage. So that's super helpful. I appreciate you guys sharing that with me as I go through this information. And look, really, to Mindy's point, we hope that you guys are engaged in the presentation. Please put a bunch of questions into the chat box. We'll answer as many as we can as we get to the end of the presentation. But my goal really is to give you an understanding of the asset class itself, what we find interesting about it, how you can potentially look at this asset class, and then some potential opportunities for you to participate as we move forward, or as you move forward in your investing journey through your self-directed IRA. So with that, let me just give a quick introduction to me. As Mindy had mentioned, I'm the CIO at Reliant Real Estate Management. I'll give you a brief introduction to Reliant and a little bit about our team. Generally, my role at Reliant is I manage the capital markets, so both the equity and the debt that we use to purchase properties. I sit on the investment committee, so I work with our acquisitions team to understand which properties we're going to purchase and why. And ultimately, who I'm ultimately responsible to is our investors who are investing their equity with us, and to ensure that we're delivering value for them. In this second bullet point here, I've always kind of had an interesting path in my own career, and there is no secret sauce to success. Everybody's path is a little bit different, and I'm sure many of you are here today as self-directed IRA investors or prospective IRA investors because you believe there are alternative strategies out there, and real estate has definitely been that for me personally. So let me give you a quick introduction to Reliant. We are a vertically integrated self-storage operator. So what that means is we are buying and managing the properties that we buy. And again, we're focused 100% on self-storage. So that's all we do. We buy and manage self-storage properties. And today we have 50 properties in our portfolio, just over 31,000 units, and that's about 4.1 million net rentable square feet. That valuation number on our portfolio, it depends who you ask, but generally our portfolio is probably between $300 and $600 million if we were to sell it today. It's very aggressive right now pricing on portfolios of our size, so we may get an outsized number if we were to try to sell it. We have about 130 employees, and the majority of those are out in the field running our sites. Actually, I need to update that top right corner here. In 2019, we were the 25th largest self-storage operator in the U.S. As of 2020, we were the 27th. So we're constantly buying and selling properties in our portfolio, so that changes. And really, our success has been rooted in having a great team. Just highlighting a few of the senior management members here, and I'm leaving plenty of people out, but we have an intimate knowledge of the asset class, over 100 years of combined self-storage experience. The two co-founders, Todd Allen and Lou Pollack, both come from a development and an operations background in self-storage. And then the rest of our team filling out operations, construction management, acquisitions, and analytics, are obviously our CFO. All of us are rowing in the right direction. And look, from a partnership standpoint and an investor standpoint, you're really investing in us. People think they're investing in real estate, but it's up to the team to make great decisions for you, and that's who you're making your bet on. So we've been very fortunate to have a great team within Reliant. So let's just give a high-level overview of the self-storage industry. And for those of you not aware of how massive this asset class is, I thought we'd start with this. Just a pure sense of the amount of revenue being done in the asset class, almost $40 billion through 2020 in annual revenue. So very large, and 49,000 facilities. Again, this is we have more self-storage facilities in the US than all the McDonald's, Starbucks, and Wendy's combined. So it's a very, it started out as a very nuanced asset class, but has certainly gained momentum over the past 5 to 10 years. The other thing I just want to highlight here is the average percentage of households in the US that rent a self-storage unit, and that's 10%, which is so if you think about 1 out of every 10 people you see in the US has a storage unit, that's a pretty big number. And if you look at the historical chart of usage, and I'll show that in just a slide or two, that has grown historically. So as more self-storage has become available, more people have chosen to use it. And I'll share with you why I think that is, and why I think it's going to be a trend for the future as well. And then just one other interesting piece, average monthly cost for a 10 by 10. So that's kind of the average size that we look at, about $89. So a relatively small percentage of people's income. And what's interesting about the asset class is it's still very fragmented. So there are 6 publicly traded companies, and it's names that you probably already know, companies like Extra Space, CubeSmart, Public Storage, Life Storage. Those are some of the publicly traded REITs. They own about 30% of the rentable square footage in the US. The other 52% is very much owned by smaller operators. It's very fragmented in the marketplace. So there's still a lot of mom and pop operators. Reliant would fall in that 16.5% top 94. We're obviously 27th, as I had mentioned, in 2020. So, you have this kind of institutional group that makes up about half of the market, the REITs and groups like ours. And then the other half is still very fragmented. So it leaves a lot of opportunity for future growth and consolidation. And this is just a further breakdown of that. These are the 6 publicly traded companies. I'm sure these names, if you're listening to this webinar while you're driving on a highway, if you look at an off-ramp, there's a pretty good bet you're going to see one of these facilities off an off-ramp if you're in any sort of population center. Public Storage is by far the largest publicly traded storage REIT with 2,800 properties. U-Haul is another name that most people know. Obviously, they know them from the moving trucks, but also have a substantial number of self-storage facilities as well. And this is, again, is just a graphical representation of that consolidation. So, we fit in this, 45% range, and, there's still a substantial amount of properties to go out and consolidate. And what that does for a group like us is allows us a lot of acquisition opportunities to go out and create value at properties where they may be owned by a mom and pop operator today and not taking advantage of some of the things that a professional management platform would allow for. This is that historical utilization that I wanted to share with you. So on the bottom, you're just looking year by year. So that's from 1987 to this is through the end of 2018, so a little dated. And as I had mentioned, in 2020 through 2020, we're at 10%. So you've seen this really consistent growth. The percent of US population using self-storage, the pie continues to grow. And it's very much been a if you build it, we will come kind of thing, because as self-storage has gained momentum and we've grown the asset class, more and more people have used it. So, 13.5 million households are currently utilizing storage. And the question is, does that continue? And, we've also seen that growth on the revenue side of things. I know we had talked about the $39 billion in actual revenues. and that's consistently grown as well. So this has really been a growth industry over the past few years. And the next logical question is, will it continue? And that's a question, obviously, that we want to answer at Reliant as well. And so here's some interesting data. I'm going to try to walk you through this slide. So the gray line represents the percent of population made up by the generations at the bottom here. So we have the greatest generation, baby boomers, Generation X, the millennials, and Gen Z. And generally, what we see is whatever percent of the population that the generation makes up. So like baby boomers make up 23% of the US population at the time we pulled this data. They generally also are the percentage of renters we have in our portfolio, right? So, it matches basically the percent of population. And what's interesting here is the millennials, and specifically Gen Z, they make up 27% of the population, but 3% of our rental base. So the question is, as Generation Z starts to enter the user-friendly years of self-storage, which is generally between 30 and 60, 30 to 70, that's where most people are consuming storage in that age group. If as Generation Z enters that group, do they get closer to 27% of our renter population? And if that happens, what's going to happen is this growth will continue. The percentage of the pie will continue to grow. So this is something that, no guarantees for sure, but this is what we're excited about. And we say, look, we think the industry is going to continue to grow because we have this big part of the population that isn't renting at all yet. And does it outpace, as this grows, does that outpace the number of boomers who stop renting? So time will tell for that, but we certainly think we're in the right asset class. And so, for you as an investor, you may ask yourself, why self-storage? And there are three reasons rooted in data that I really like, hopefully that resonate with you as well. I look at basically two things up front. Is one, historically, I'm a big believer that whatever you've done historically is generally a good indicator of how it's going to turn out moving forward. And so if you look at this historical track record of self-storage as an asset class, and this data is coming from the National Association of REITs, which is they track all of the publicly traded real estate investment trusts across all asset classes. And there's a link to the bottom where it's referenced, and you can go see this data yourself. But over the last 25 years, storage has done just under 17% a year in annualized returns. And when you compare that to some of the other more traditional asset classes in real estate, think apartments, retail, office, storage has outperformed. And certainly compared to the S&P 500 over that same time period, storage has done very well, certainly outpaced the S&P. And so you have this asset class that's done very well, but you also have this unique downside protection. So, when we originally built this slide, COVID hadn't happened yet. So we looked at the last down cycle, which was 2007, 8, 9, and storage was down about 4%. And if you look at compared to apartments, closer to 7, retail double digits, office 8%, S&P 500 obviously got crushed. We saw this nice recession resiliency. And we'll touch base on that in just a moment, why I think that happens. And with COVID, we've seen a very similar trend where storage has performed very, very well. We're recording this at the end of April of 2021, so we're certainly not out of COVID yet, but as vaccinations start to take hold and we return to normal, we've been very blessed in that storage has done very well. And I'll share the reasons why I think that has happened in just a minute. And then lastly, we touched on this, is the market consolidation opportunity. For publicly traded companies, they own a very small percentage of the pie. And so there's some nice opportunity for a consolidation or a roll-up strategy, both for you as an investor and for us as an operator, because there's definitely a lot of interest at the institutional capital level for the larger transactions, the portfolio level sales. And with a lot of mom and pop operators, there's plenty of value to be found out in the marketplace. So this is the question that we get almost every day, right? Why should I invest in self-storage? And then secondly is, how has self-storage performed during the COVID-19 pandemic? And the answer is very, very well. And so what you're seeing on this chart is, again, this is the NAREIT data, National Association of REITs. And again, on the left-hand side, these are all of the individual categories of the differently publicly traded REITs. So, if you look at office here on the top, this is the office REITs across the country. There were 19 of them that reported, and in 2020, they showed a negative 18% loss, right? So office had a tough time as people were working from home. Self-storage had 5 publicly traded REITs reporting, and they did just under 13% a year, which is fantastic. Really only outperformed by data centers, and there's 5 publicly traded data centers, 21%. But if you look at lodging and resorts, right? So that's hotels. Hotels got crushed during the pandemic, to no fault of their own. It's very hard to run a business when there's no revenue, but they were down 23%. So we've seen this distinct cycle. Remember, back in 2007, 8, and 9, storage did very well. And now we have COVID, where it looks like storage is going to come through having done very well as well. So, and the question is why? And what we look to in the asset class, you'll see here on the top, we talk about what creates demand for self-storage. And what that is really, we call it the 4 Ds. And that's death, dislocation, downsizing, and divorce. Generally, what that means is you have transition in your life. So if one of those 4 things is happening to you, generally there's some transition going on. And so when that happens, that's when you need to consume storage. And fortunately for us, unfortunately for the general population, during the pandemic, there's been a ton of all 4 of these things. Obviously many people have been passing away, which is terrible. People have been moving or dislocating, right? They're moving to new places. They're downsizing. Some people are downsizing and living in an RV. Interestingly, divorce rates are at all-time highs in 2020. One of our largest investors is a divorce attorney who owns a very large firm in New Jersey. And in 2020, he's had the biggest year ever. And his point was, when you take 2 people who don't like each other and make them stay in a house, generally that doesn't turn out well. So you've had a lot of divorce, and that's created demand. So overall, we've seen an occupancy and revenue growth year over year through COVID. And that's not just our portfolio, that's also what the REITs are reporting, which is a good snapshot of what's happening at the national level. And a couple trends that I think are worth thinking about in the asset class specific to COVID is, not only have we seen this increase in demand, but then also what had happened was the chart that you're looking at here on the left-hand side, it's measuring the millions of square feet that have been completed year by year or quarter by quarter through 2019 through the 4th quarter of 2020. And so what you're seeing is, this is new supply coming to market. These are new facilities that are opening, and now those are available to rent. So you saw in Q2 and Q3, you see these big, strong deliveries, right? So that's all of the stuff that in Q3 of 2020 that was almost to the finish line when COVID kind of started. And then in Q4, you see this precipitous drop. And what happens is, when no new supply is coming, the vacancy is dropping because there's less new units to fill up. So all the current units are getting more of that business. So that slowed delivery is really improving the current performance of storage facilities today. And the other thing that's happening is, we're seeing all kinds of delays in new construction. So if you're going to get a new construction project approved in 2020, many municipalities didn't work for months at a time. They were working from home. Getting approvals on building permits was very challenging. And we can tell you from the construction we did that there was a lot of delays. So we expect this trend to continue through 2021, where new supply is going to be whittled away. We're going to see less new supply delivered in 2021 than we did in 20. And this is that chart again. On the bottom, you're seeing year by year, so from 2002 to 2020, and then year over year supply growth. And what you saw was, after 2009, nobody was developing new storage facilities. And then they saw how well it did during the recession and said, oh, we can develop a storage facility. They did really well. So we've had this big growth, and it peaked in 2018, where we've seen a lot of new supply coming to the market. And then you'll see us start to trail off. In 20, that drops. In 2021, we expect that trend to continue, where there won't be a lot of new supply delivered to the market for that reason. And then one more trend I think is worth pointing out. For those of you familiar, CMBS loan it stands for Commercial Mortgage-Backed Securities. And you can see this data, it's public data to see the delinquency and default rates on CMBS loans. So what this means is these are, if you are delinquent on your loan, this is like if you're delinquent on your mortgage. Generally, you lost your job or you don't have a way to pay your mortgage. So in real estate, commercial real estate, if you see a very high delinquency rate in a particular asset class, well, then it means that the asset class is getting hit by something in the market. So if you look at the chart, what we're showing is the percentage of loans that are delinquent on the left-hand side, and then across the bottom are months and days. So look at this trend here. So orange represents self-storage, and then gray is all CMBS notes overall. So look, we're doing pretty good from 2000 to 2008, and then you see this huge spike in delinquency. Storage not as bad, right? But still some delinquency for sure. But the overall market was peaked at just above 10%, and storage was at 4%. So compared to the overall market, nothing. But as you go into 2020, look at this spike here, April 2020, a huge spike, and then it's starting to drop off. Look at storage. As of September in 2020, only 3 of the 1,700 CMBS loans were marked delinquent. So about 0.1%. So what that means is self-storage assets are doing well during the pandemic, and they're still able to pay their rent or pay their mortgages. So we've been excited about it. Hopefully this answers the question of, how has the asset class done? And then I think that the next question is, we've proved, okay, it's done pretty well during COVID, but is that sustainable? Are the trends in a position where, we feel like it's going to continue moving forward? And so here's some things to think about that COVID has done and how it may affect self-storage. So, people in their homes have consolidated, right? If you or your wife or your husband or whomever is at your house and you're working from home, you've had to consolidate space because now you need an office, right? So people are working in their bedrooms and they're creating space to work. So they're moving other things out of their homes, and many of those things ended up in storage. College campus closures, right? So from our perspective, 1/3 of the U.S. universities and colleges went back this fall in person. So that means 2/3 didn't. So many of the students who stayed home left their stuff in storage. And what's interesting about self-storage is once you use it once, you're much more likely to use it in the future. And there's data supporting that. So we have this, again, growing of the pie of users of self-storage, and we're expecting that to continue. And obviously the work from home trend, I think will continue to push that as people realize they don't have to live in the metroplexes to complete their jobs. This is allowing them to be in more rural areas, and so they're spreading out, they're moving, and it's creating demand for self-storage. And then, capacity restrictions. This is an interesting one. Businesses also had to reevaluate how they use space, right? Think about restaurants who they had a 25% capacity limitation, right? And so they had to move furniture, they had to move things out of their facility so that they could accommodate that. We feel like that was a good demand driver, but also will allow them to see, hey, this is self-storage. In the future, when you need flex space, you can roll into a self-storage unit. And then this is an interesting demographic trend that I know you guys are already seeing, and I'm sure you've read about, but COVID has pushed into a net migration from certainly the Northeast, some California as well, into the Southeast, Southwest. So we're seeing a big influx, and you'll see by color code, the darker gray represents a higher amount of people, The lighter gray means, maybe 0 or less. So we're seeing the migration into states like Florida, Georgia, Carolinas, Tennessee, Texas, Colorado, Nebraska, Arizona. And what's happening, the dots represent our self-storage year-over-year rent change. So no surprise, where you see migration in the South, you're seeing rent growth as well, right? And so as this trend continues, as we continue to see migration into these the states, and at Reliant, we're operating primarily in the Southeast, so Tennessee, the Carolinas, Georgia, Florida, Alabama. As you see migration into these warmer weather, more tax efficient states, we're seeing rental growth as people come in. So, and that's a trend that we expect to continue, probably as a effect of COVID, and we think is going to continue moving forward. And then this is kind of back to that long-term demographic outlook that I shared with you a little bit earlier. But what's interesting, again, millions of people on the left-hand side, and the color codes are the different generational cohorts of our population. So orange represents Gen Z, green represents the greatest generation. So right here, right, is kind of 30 to 65. This is the bulk of who's renting storage. And as you can see, this generation has not yet gotten there. And what will be interesting to see is now the millennials are in that peak rental age group, right? So we're getting more millennials renting storage because they're buying homes, all of the things that are creating need for storage. Well, the question is going to be, what happens with Gen Z as they enter the self-storage user group? And will it outpace as boomers start to fall off the user base? Our belief is that these guys are going to outpace the boomers dropping out, and ultimately, instead of 10% of the US population, that number that uses self-storage, will continue to grow. So, these migration patterns are helping, and then we're certainly seeing some generational things happening that we think will create growth for the long term in the asset class. So, look, with any opportunity comes risk, and I'm going to walk you through what I think, some of the risks are. Supply has been a big risk in self-storage, new supply. So if you increase the supply in a marketplace, then generally prices are going to drop, because new facilities are going to try to get people in there and get the facility full. And so how they do that is they add pricing concessions, discounts, rebates, whatever, to get people in the door. And what you're looking at here is the millions of dollars on the left-hand side spent on the construction of self-storage. And so you see this precipitous rise. And as I had mentioned, it peaked in 2018, dropped a little in 2019. Each one of these bars represents a month in the year that is reflected down below. And so you're starting to see it drop off here in 2020. We think 2021 is going to be a pretty precipitous drop on the amount spending for two reasons. One, the projects haven't been approved because of delays on the approval process, but also two, construction materials have gone crazy in the last 6 months. I'm sure you guys have seen the prices of lumber and steel, which are obviously key components. So it makes it less efficient or more difficult to earn an ROI on those construction spends. So we'll see what happens, but that's certainly a risk. Another risk in the asset class right now is there's a lot of institutional interest in self-storage. So many of you may have heard of the asset aggregator Blackstone, a big real estate, or they have a very large real estate portfolio. They bought a self-storage operator called Simply Self-Storage, which actually one of the co-founders of our firm came from Simply Self-Storage, but they bought that back in October of 2020, and it was a very aggressive price that they paid, and really raised the eyebrows of a lot of people in the industry, because what it signaled is big boy money, institutional money is trying to enter the space. Bill Gates invested through a group called Cascade. They helped recap one of the largest self-storage operators. I think the Gates Foundation put close to $500 million of their money into a self-storage operator. And again, it's a big name, right? You hear Bill Gates and one of the richest men in the world investing in storage. So it made a lot of splash in the internal industry. But you're seeing a lot of institutional capital coming in, and it's driving prices up. So it's much harder to find value in the marketplace, which is also a risk. You got to be careful as an investor that you don't overpay up front. And then, I'll turn this over to Mindy to have a better sense of the IRA side of it, but there's certainly some risks in breaking the IRA rules. And so Mindy, maybe you could touch base on, I know you touched on this in the beginning, but what some of those could be.
Yeah, absolutely. So as I mentioned earlier, when you're utilizing a self-directed IRA, it's very critical that you understand who a disqualified person is. And the reason for that is the IRS says that if your IRA does business with a disqualified person, that is considered a prohibited transaction. So again, a prohibited transaction is any improper use of an IRA or plan by the plan participant or a disqualified person. So what that means is at no point is your IRA allowed to do business with any disqualified person. So that means buying, selling, transferring ownership, or providing goods or services between the IRA and a disqualified person. The one exception to that is that at the initiation of the purchase, you can partner with a disqualified person. So let me just give a quick example of what would be a prohibited transaction. Let's say that your father owns a self-storage company and he's raising capital and he's looking for investors, and you want to invest in your father's self-storage company. Your father is a disqualified person to you. So your IRA cannot be an investor in your father's self-storage company. Another example might be, let's say that your father is only 60% owner of the self-storage company. That would still be a prohibited transaction because he is 50% or more owner in an entity where your IRA would be an investor. So very, very important that when you're using self-directed IRAs that you understand who a disqualified person is.
Super helpful, Mindy. I appreciate it. Yeah, so I think when you think about the risks, obviously risks specific to the IRA and how you should think about that specific to the asset class. Look, the other thing that you want to make sure is that you're doing your due diligence. So I just gave you a lot of reasons why self-storage is a great asset class to participate in. But we have an acquisitions team that has been doing this for probably combined 15 years of just looking at self-storage deals every day, all day. And we have 50 properties of assumptions, right, that we know what we can assume in a financial model, because, we can look at our 50 properties and say, hey, here's generally what we're getting for rent growth. So we can assume that in our models moving forward. And so, you want to make sure that you're really doing your due diligence so that you don't get hurt. Hire professionals to do it with you, partners to go in on the deal who maybe have more experience, because to the bullet point, pet due diligence can be costly. That's how you lose principal, right? That's how you lose your investment amount, is not understanding what you're getting into up front. And for you guys as self-directed IRA, if your IRA is going into a specific deal, you want to make sure that you're doing all that you can to identify both the opportunities and the risks in the deal on the due diligence side of things. So here's some things to think about on the underwriting. And this is generally going through how our process works, and everybody's a little bit different, but first you got to identify a property that fits what your category is, and think of this as if you're investing directly. So your IRA is going to go buy a facility directly. You're not partnering with a company like Reliant. You're going to go identify the property. So, some things you can do. Obviously, there's groups like, LoopNet and online broker listings where you can go see it. And what I would suggest is, if you're looking at a specific market, you want to make a relationship with the broker in that market. Find the broker who's listing these properties in that particular geographic area, and they're going to be the best indicator to help you identify what that property looks like. But it's got to meet whatever your location demographic information is that that you want to involve yourself. And then, what's interesting about storage is it's a very micro market game. So the only thing that matters is really the 1, 3, and 5 mile radius around your facility. So a little bit different than like apartments, right? Where you're looking at market level data to understand, is there job growth? Is there population growth? Because if there's people moving in, there's going to be demand for apartments. With storage, because it's a garage, it has to be convenient to either work or home. If it's not, you're not going to drive for a specific storage facility, right? There's no amenities. It's not in a school district like an apartment might be, where you say, look, this apartment's out of my way, but I'm going to go there because the school district's great for my kids. In storage, it isn't. So it's got to be convenient. So that 1, 3, and 5 mile radius is really what we dig into, and you should as well, understanding who the competitors are in that particular, those radius or those radii. And then, with the competitors, who's the supply and demand? How much supply in the market is there? What's their average occupancy? Are they full? Because if they have 10 facilities in a 5 mile radius and all of them are at 70% full, well, you probably don't want to be in that market. So market research is critical. And to give you a sense, for us, in most markets that we're in, about 70% of our tenants are coming from a 3 mile radius. So it's really important to understand that intimate market level overview. And then you got to have a model, right? You got to have a pro forma, a financial model that helps you understand, okay, this is what I think I can get for income. This is what I think my expenses are going to be for each year that I'm owning it. And right, expenses are going to go up, and hopefully income goes up, right? You're adding rental rate bumps in there. So you want to have a model that shows you how can you pay your debt service, can you pay your mortgage, and are you going to make any money on this thing? And there's a number of people out in the industry that can help with that modeling from like a consulting basis. Highly recommend that you go out and do your due diligence on who's helping you build these models if you don't have experience doing it. And then look, find a peer group who has experience in the asset class that you can run these models by for them to poke holes in. Because it's real easy to convince yourself that it's a great deal. So, find a way to bring this in front of people who have experience that can say, hey, that's not a fair assumption, or you're being too aggressive here, too conservative there. And then you start the process by submitting an LOI. So you submit the letter of intent to the broker. If it's listed or the owner, they decide if they want to accept it, and then you go into your due diligence process with the property. But look, this underwriting process is a critical component to make sure you know what you're getting into. And then once you acquire the project, you have a business plan, right? And for us, I'll use Reliant as an example. Most of what we do is value add, right? Where we're buying a property, an existing asset, and we believe there's some opportunities for revenue enhancements. So things like U-Haul truck rentals, tenant insurance, we may build an addition to the facility and add square footage, but something that grows the revenue of the facility. Because in commercial real estate, the values are based off the NOI, or the net operating income that the property produces. So if you can grow NOI, which is just basically profitability, then the value, all other things being equal, the value of the property is going up. So you want to make sure that you have a plan to grow revenues. For us, sometimes it's putting a shovel in the ground and we'll build out additional square footage and get that leased up. It could be the things I mentioned, U-Haul truck rental, those are called ancillary income items. But you want to have some plan. And then depending on your strategy, we look at it as, what's our exit? How do we get out of this thing once we've created the revenue? And generally, we're holding our projects, we project about a 6-year hold. We've sold 38 in our history, and our average hold time is just over 3.5 years. But generally, we predict 6. And then we think about, okay, who would be a buyer for this? Would it be one of the REITs, right? The 6 publicly traded companies we talked about. Could it be an institutional money group who's out looking to deploy in the space? Or is it a smaller player and you're just trying to find another operator? So you want to think about, as you're acquiring, you want to have your exit strategy in mind so that you can really build an ROI for yourself. Don't go in with no plan and say, hey, 5 years from now, what am I going to do with this thing? Unless for you, it's a long-term forever type hold. So, just think through these things, build your business plan, execute on the enhancements, and then hopefully you get to a position, where you can exit the assets. So what I wanted to do is just give you kind of a case study as we talk through all these things in self-storage. This is a property that we purchased at the end of 2020 in our current fund. And I just wanted to give you a sense of how these things kind of all come together. So this was an asset that we purchased in Wilmington, North Carolina. For those of you guys familiar with it, it's on Carolina Beach Road, which is kind of a peninsula south of Wilmington, the Metroplex of Wilmington. And what was really interesting about this asset is if you look at it on a map, it sits on this peninsula and there's a lot of population to the south of it. Well, all of our main competitors were just north of the facility, but there was only one way in and one way out off of this peninsula. So if you lived to the south and needed self-storage, you had to drive by our facility to get to the competitors. And remember what I said, no one is driving for storage unless we have really bad customer service, or if it's a terrible facility, generally it's a garage. So if it's a safe garage and it's dry and clean and the people behind the desk are nice, you're probably going to go to the one closest. So we really liked the market story, and the opportunity for value add here was, we had an expansion potential. You'll see that little parcel in the back of the land here where we're going to build out an additional 11,000 square feet of storage. So what that allowed us to do is build out some additional units and then we will get those leased up. So we just bought this. We're in the midst of pushing dirt right now. We're just starting the construction component. But what some other metrics to think about is traffic count, right? So how many cars are going by your facility every day? Ours is 34,000 cars. So generally we use the metric of about 10,000 cars as kind of the limit. If it's lower than that, there's just not a lot of eyeballs seeing your facility. So 34,000 cars a day is fantastic. Population growth within 5 miles grew 21%. So you're seeing a lot of growth in the area. And then we mentioned that undersupplied market. So a lot of smaller competitors to the south of us, and the competition was very minimal. And what we liked about this, and just to kind of give you an update, when we purchased it, the occupancy was at 82%. This was built in 2018 and leased up very quickly. Right now, we have not done the expansion, but our occupancy is at just over 95%. So it's validated kind of our thought process on the market, right? There's a lot of pent up demand there. So we're really excited to get this expansion complete so that we can rent out those additional units. So just kind of an interesting, case study. Hopefully it kind of ties together how we think about the world and how you should be thinking about a potential investment opportunity when you think about self-storage. And then the last point I'll bring here, and this is more specific to us, is we own 3 properties in the region. So for those of you guys familiar, Pawleys Island, Murrells Inlet, a Little River. So we own some facilities around that. So this would be an asset that we sold as part of a portfolio, which again makes it more attractive to some of the larger institutions. So this one checked a lot of boxes for us. So I thought it would be a good case study for people to understand, all right, how are operators thinking about self-storage investments? And so, I think when you think about the investing strategy, you want to first decide which markets you want to be in. And, that can be thought process of you want it within a 2-hour drive, or an airplane distance, something where you can get your hands on it. And then you got to start to identify the process the project, as we had mentioned, and then that due diligence process, right? I can't tell you how important it is to put your work in up front, because many times once you're in it, it's too late once you find those mistakes. So I would encourage you to start with identify the market, then start to dig into how are you going to identify the property, work with a broker, start to look at what listings may exist online, and then do your modeling and your due diligence, have a professional help you with that, so that you guys, you can make good decisions on the investment. And then hopefully you can, make a letter of intent or an LOI, an offer to the seller. And this is the other way to think about investing in storage, right? So there are two types of investors, direct investors and passive. And some of you who may be on this call right now are thinking, all right, I'm going to go buy my own facility. That's a direct investor, right? So you take your IRA and you say, all right, I'm going to go buy this facility, I'm going to run it myself, or I'm going to hire a management company, and I'm going to earn the returns on that. And more power to you. You know, it's a great way to approach it. But it takes a lot of time and energy and learning along the way. And then we have a lot of, or there are a lot of people, and this is who most of our investors are, who say, look, I love the story of the asset class. I want to deploy some capital in the space, but I'm not going to go buy my own facility, right? I want to partner with someone who, you know, has experience in the asset class and a track record. I want exposure to the asset class with my capital, but I don't want to run it. I want somebody else to do it. And really, you know, groups like ours, Reliant, we work with a lot of passive investors, and there are other operators as well in self-storage, in multifamily, in office, industrial, who use passive investors to invest alongside of them. And, you know, here's what I would say, and I was a direct investor, and I guess I still am through Reliant, but we have a whole team around us. But what I realized was, for me, I buy into the 10,000 hour rule, right? So to make an expert at something, you got to spend 10,000 hours. Well, in my life, I only have so many 10,000 hour blocks until I'm dead, right? And the question is, do you want to spend that 10,000 hours in becoming an expert on buying self-storage, for example? And for me, the answer was, at the time, no. I'd rather deploy my capital with someone who knew what they were doing and let them make great decisions, because hopefully they've already learned from the mistakes that I'm inherently going to, right? You're going to make mistakes, but if you partner with somebody who's been doing it for a while, you know, hopefully you don't make those, they don't make those mistakes. So I think this is the starting point for most of you on the call is, do I want to be direct? And if you do, you know, we talked about start here. If you want to be passive, then find operators who you can deploy capital with, you feel good about, that get you exposure to the asset classes you want, but you can partner, you know, and use their 20 plus years of experience to hopefully deliver a great return for you. You know, so from my end of things, I would say we are open to questions, and I know Mindy has a couple other slides, and then we'll turn it over to the Q&A. But feel free to reach out to me if you have additional questions. My email is down below. Happy to help. This is just a picture of our team in our office. I'm talking from our office in Roswell, Georgia. We're just north of Atlanta by about 20 miles. So feel free to reach out to us, and if you have any questions. And Mindy, I'll turn it over to you to kind of take us from here.
Yeah, great. Well, thank you, Chris, for the excellent educational overview of the self-storage industry. Could you go back one screen? Oh, I'm sorry, forward one screen.
Sure.
There we go. So for anyone that is interested in investing in self-storage or any alternative asset with a self-directed IRA, I just wanted to briefly go over what that process looks like. It's 5 basic steps. The first step is going to be opening up your self-directed IRA with a custodian who is willing to hold those alternatives. The second step is going to be funding your self-directed IRA. And to fund your self-directed IRA, you can do that in a variety of ways. Any IRA that you have, you can transfer that to a self-directed IRA. It does not create a taxable event or a reportable event. If you have money in an old 401k, 403b, 457, TSP, any type of qualified plan, typically where you're no longer employed, you can roll over that money to a self-directed IRA. You also can fund the self-directed IRA via a contribution, or you can also fund the self-directed IRA with a combination of a transfer, a rollover, and a contribution. Very flexible in the way that you can fund a self-directed IRA. The third step is identifying the investment. The fourth step, and a very, very important step, I know Chris spoke on this, I want to reiterate it again, you need to do your due diligence on the asset that you're investing in. Entrust or any self-directed IRA custodian, they are not fiduciaries for the asset that you're investing in. So it's up to you to do your own due diligence and to understand that you as the investor are your own fiduciary. And then step 5 is to make the investment and maintain the investment. So what that means is if you're buying the asset in full with your IRA money, all expenses are paid from the IRA, all income that asset generates must go right back into your IRA. So that is the 5 basic steps of investing in an asset with a self-directed IRA. And before we dive into the live Q&A, for those of you who don't have time to stick around, I just want to briefly mention what's coming up next. We do have another webinar scheduled for May 19th on multifamily real estate. If you would like more information on today's topic, please complete our brief webinar survey. We do value and love your feedback on topic suggestions. So we do have a 2-question post-event survey at the end of the webinar when you exit. So if you have a few minutes to spare, we would really appreciate you taking the time to complete the 2-question survey. All right. Now we are going to answer the questions that we've been receiving throughout the presentation. Again, if you do have questions, go ahead and type those now into the live Q&A box, and we will be answering those questions. And Chris, do you want to flip to the next screen?
Sure.
Yeah, thank you very much. Also, my contact information, Chris's contact information, reach out to us directly with any questions that you have. We'd love to hear from you. All right, we're going to go into the live Q&A. The first question that we received, if we buy a piece of land and build a home on it with a self-directed IRA, funds and then we decide that we want to live in the home, can we buy it from our IRA? So the answer to that is you cannot buy it from your IRA. So I mentioned earlier, at no point are you ever allowed to buy, sell, transfer ownership, or provide goods or services between your IRA and any disqualified person. You yourself are a disqualified person to your IRA. Now, there is a way that you can actually live in a home that your IRA owned. And the way to do that is by taking an in-kind distribution. So what that means is instead of taking cash as a distribution, you can actually take a piece of property, the value of that property as a distribution. And you can do that all at once, but for some people, that's a pretty big tax hit. So you can do partial in-kind distributions and spread that out over multiple years. Completely up to you how you do that, but that is the only way that you can ever live in a home that is owned by your IRA. All right, next question. Can you invest in US gold coins? So you can invest in gold metals. They do have to be IRA approved. So the dealer that you're working with should be able to confirm whether or not it is IRA approved gold. Do any of the IRA investment accounts earn interest? At Entrust, they do not. They sit in an FDIC insured bank account. Does Reliance have any opportunity zone self-storage opportunities? Do you have anywhere, do you find opportunity zone investments in self-storage?
So right now the answer is no. We're raising capital through a fund, an equity fund. It is not an opportunity zone fund. We do not have any opportunity zone investments. But Mindy, there are a number of operators that do. So for those of you familiar with opportunity zone, essentially it's a tax deferral strategy where you can take some capital gains that you've made. Let's say you sold a stock and you've made those capital gains, and you can defer those taxes into a real estate investment. Right now, Reliant does not have any of those.
All right, thank you, Chris. How long to lease up a brand new 600-unit self-storage project?
I hate to give you the it depends, but boy, there's a lot of variables in there that factor into it. Generally, how we underwrite lease up pace is a percentage of square footage, and it's based off of the market, what we've seen in the market, or if we have other assets in the market, what we've seen them, how they have performed. But you know, I hate to give you a non-answer, but the answer is going to be super dependent on where that 600-unit self-storage project is. You know, what the competitive set is around it. Are there new facilities also opening in the market in that 1, 3, and 5 mile radius? If it's a more rural area, maybe you look even a little bit further. So, you know, I apologize that I'm not giving you a more specific answer, but it very much depends on a lot of variables.
All right, thank you. Can you address zoning issues for new SS buildings?
Sure. Again, very municipality specific. You know, it depends what the property is zoned at currently. And for those of you guys not familiar, I think what they mean is if you are trying to get a piece of land appropriated so that you can build a storage facility there, what are some of the issues? And, you know, look, depending on the municipality, it also depends on how many storage facilities they've seen in their town. Storage isn't one of those things that every city wants. Generally, every city wants mixed use retail, right? Where you have housing on top, retail on the bottom, because, you know, that brings people into the community, creates walkability. So storage is one of those things that, you know, they can be beautiful buildings, but it doesn't necessarily add to the value of the community. So it really depends on the municipality. Some of our more rural areas, they love storage because it's great tax base increase for them, right? You know, it's not a house. There's a lot more taxes that they can derive from us, and they're happy to have it in their town. You know, a town like we have a facility in Rock Hill, South Carolina, that the municipality actually put a moratorium on any new self-storage development. And the reason was because they've seen so much new development in those, as we had talked about earlier, in the previous years, that they said, look, we're not doing any more of this. If you want to develop, you have to be in these specific areas of our municipality. So, you know, there's, aside from just the municipality wanting you to be there, I mean, you got to dig into the environmental issues, right? Is the land appropriate for self-storage facility? And then, you know, the density, what will they allow you to put there? How big is the parcel of land you have? So a lot of things go into that development process, and understanding how to zone the land appropriately for your project.
All right, great. I think this next question is also for you. At some point, the growth has to stop, correct?
I guess the question is what growth? If the growth is the number of people utilizing self-storage, I would argue it's only 10% of the population, and some of those demographic trends that I had shared with you, I think would suggest that there's still a big chunk of people that could potentially be users and expand the pie. I think that's what we're speaking to the most is, you know, will we get to a point where the pie has, you know, reached its zenith? Potentially, you know, but I think in our investment cycle that we think about, probably not in the next 5 years, right? So I would argue that the growth in the short term is these demographic trends of people moving and, you know, coming of age in the self-storage user base. Those are going to be the things that drive the growth moving forward.
All right, great, thank you. All right, next question. Will Chris be able to indicate a range of multiples they consider reasonable when they acquire a going concern?
Say that to me one more time, Mindy. Will Chris be able to indicate a range of multiples?
Yeah, it says, will Chris be able to indicate a range of multiples they consider reasonable when they acquire a going concern?
I don't know what a going concern means, but if we're talking about a range of multiples, meaning kind of multiples on your equity invested, you know, I can only speak to ours. You know, generally, you know, we're shooting for, from an investor return standpoint, you know, somewhere in that, let's call it 1.7 to 2 times multiple on their money over the hold period. So I apologize if I'm misunderstanding the question, but, you know, generally think of it that way is, you know, at least for the projects we're trying to do, somewhere in that 1.7 to 2 time multiple on equity invested.
Okay, great. And whoever asked that question, if you want to reach out to Chris directly to maybe further clarify, you can go ahead and do that. All right, next question. Is there a standard business plan template that you offer for self-storage?
I'm assuming they're asking me that. No, you know, we are a self-storage operator, so that's what we do all day, every day. But we don't do any sort of, you know, coaching, consulting for other people trying to get in the self-storage asset class. You know, what I would say is there are some groups out there. There's a group called the Self-Storage University where you can go and pay and spend a weekend, or I think it's a long weekend type course to learn more about the specifics of the underwriting and the asset class. As I had mentioned, you know, we generally are partnering with people who say, hey, I want to be a passive investor in your deal. And that's where we've focused our time. We don't do anything on the coaching side of things, but there are opportunities out there for you for sure.
All right, great, thank you. All right, next question also for you. Is it cheaper to create a newly built asset than acquire an existing facility?
Again, depends. Right now, the challenge is that material costs have gone very crazy. So steel, lumber, the kind of the basics have gotten really expensive. So the replacement cost or the cost per square foot to build a new facility has really skyrocketed. It depends on the market you're going into and how expensive the land is, right? So if you're in, you know, downtown Atlanta or downtown Manhattan, to purchase the land is exceptionally expensive, right? You're going to pay through the nose to get that. And the building cost isn't really going to be the issue. If you're in, you know, a more rural area, let's say, you know, Statesboro, Georgia, kind of out in a more rural town, the land's going to be cheap, but it may cost you a little bit more to think about how much it costs per square foot to build the facility. So that number fluctuates based on building costs and land costs. You know, but generally what we're trying to do is we're trying to buy facilities where there's a gap between the replacement cost on the development side and our acquisition cost on a currently cash flowing asset. You also have to factor in when we're buying and acquiring asset, you're buying cash flow. If you build a facility, it's empty. So there is no cash flow. You've got to get it there. So when you look at that price per square foot, you got to think about how much of that price per square foot is actually buying you the cash the property is producing, and then balance that against the risk of, all right, I build a facility, it might be cheaper, but then I got to get it from 0% occupied to whatever the number is that actually makes me money.
All right, great, thank you. When you say invest, are you suggesting purchasing operational storage facilities or building one?
Both of those are investments in self-storage. So if you're thinking about investing direct and you want to do this on your own, you could purchase, you know, an operational facility for sure. You could purchase the land and try to develop a facility. There's value in that as well. With us at Reliant, generally our investors are investing with us, and our focus, although we do a little ground up development, mostly what we're doing is value add deals, where we're buying an existing asset like the one I showed you, and we're doing something to force appreciation into that model. So, you know, with us, I would say it's mostly buying additional assets, or I'm sorry, existing assets, and having some value add component to them.
Okay, great, thank you. Next question, still unclear on disqualified person, specifically you/me. Can my individual self-directed IRA invest in this self-storage alternative asset? So your IRA and you are two separate entities. So you are a disqualified person to your IRA and vice versa. When you invest in self-storage using an IRA, you personally are not the investor. Your IRA is the investor. So for example, on the purchase agreement or subscription agreement, when it asks who the investor or the subscriber or the purchaser is, it's not your name, it's going to be vested in the name of your IRA. So for example, if you had an account with Entrust, it would be the Entrust Group, Inc., FBO, your name, your account number. All right, next question. How is the best way to invest in self-storage? Are there orgs like Chris's company with whom you can invest?
Well, I'm certainly biased to the answer of this question, but yes. So my opinion is you invest with a professional operator who's been doing it for 20 years and has a great track record. That's probably the best way. Now, you won't make as much money if you do it successfully as a direct investor, but we work with accredited investors who can invest alongside of us, and you get obviously the professionalism or the experience of our team, and hopefully some of these outsized returns that storage has produced historically.
Okay, great, thank you. All right, next question. Please discuss impact of UBTI on returns. So in Trust, we are not tax advisors, so we don't discuss UBIT tax. And typically UBIT tax is determined based on how income is reported on K-1s. Chris, do you know off the top of your head the impact of UBIT on your offerings?
Again, I'll make the same disclaimer that you just made, Mindy. I am by no means a tax professional, and you should not listen to me at all. But it is 100% dependent on the amount of profit that is derived from the mortgaged part of the property. So it very much depends. And when you say UBIT on returns, does that mean on our projects, on your projects? UBIT is definitely something that you should talk to your attorney or your tax professional about, to understand where the impact of that could be in an investment like ours, or if you're doing it on your own.
Yep. All right, great. Next question. You mentioned rental rate bumps. Are they consistently going up like residential rents?
So it's market specific for sure. You know, generally our rental rate increases are just a bit above the inflation, like a consumer price index growth model. So, you know, like that 4% range in our current fund, our projected return is just over, or our projected rental rate increase is just over 4%. But remember, that 4% is on a very small number. Remember, the average 10 by 10 unit is $89. So let's just use $100 because the math's easier. If I rent a unit for $100 a month and I raise my rent 4%, that's $104 a month. So a total of $48 over a year. So there very much is rental rate growth year over year, especially during the last 12 months in COVID, where the demand has skyrocketed. Prices have jumped substantially.
All right, great, thank you. Next question also for you. Are you mostly in secondary markets?
Yeah, so I would say that we focus primarily on secondary and tertiary markets, so the smaller markets. And you know, for those of you guys who are interested, we can send out a deck. There'll be a poll for you at the end, and if you want us to reach out, we can send you out a deck with our most recent opportunity in there, and you'll see the types of markets that we're working on, as well as our track record historically. But you know, we focus on the smaller markets because there's more yield for us and for our investors. That's why we focus on those smaller markets. The primary and even the secondary markets have become very, very competitive. There's a lot of capital chasing those deals, which means prices go up, which means there's less return. So I would say we 100% focus on secondary and tertiary markets.
Great, thank you. Next question. I have a self-directed IRA with precious metals now. I need to add another one. I'm sorry, I need to add another self-directed for these kinds of, do I need to add another self-directed IRA for these kinds of alternative investments? So I'm not sure what other custodians requirements are, but with Entrust, if you have a self-directed IRA, you can invest in precious metals or self-storage, any of those in the same account. So we don't require you to have separate accounts for those types of investments. Is there a minimum investment for Reliant?
Yeah, so in our current fund, Mindy, the minimum investment is $50,000. And again, you have to be an accredited investor to participate. If you're not familiar with that, just Google the term and it'll give you the dictate, or it will dictate what those definition is. That's a requirement by the SEC.
All right, next question. Okay, let's see. Are you buying interest in the income, or is it an equity play?
I'm assuming that means with an investment with Reliant. The answer is your investment is part of the equity in the capital stack of the project. So you would get your pro rata share of income based on your investment. And what you're investing in, your IRA, let's assume you're investing with your IRA, is investing in the LLC that is the fund, and the fund owns all the individual properties below it. So you get your pro rata share of income, expenses, and that's all reflected on a K-1 at the end of the year.
Great, thank you. All right, next question. Can you roll over a KEO fund? As long as the plan administrator allows you to, yes. Typically, if you're still employed with the employer where you have that, they typically don't, or they have restrictions on the amount that you can roll over. I always suggest contacting your plan administrator to confirm that you can roll over or transfer the funds. Let's see, next question. 6% property management fees seem high for an operator of your size. How does it compare to your peers?
So what you may be thinking about is property management fees for apartment communities. Generally apartments are in that 3% range. Just remember that the amount of revenue at the properties is much, much lower, right? You may have 200 units at an apartment community where everyone's paying $1,000 a month. We may have 500 units at a storage facility, but they're paying $80 a month. So our revenue is much lower. In the asset class of storage, that 5 to 6% range is pretty much market standard for property management fees.
All right, thank you. Next question. How about tax implications with investing in self-storage fund through a self-directed IRA? If the fund issues a K-1, oh, the question just went away. If the fund issues a K-1, will I be affected by UBIT? Again, we always recommend contacting a tax advisor to answer any tax-related questions.
Agreed.
What's the difference between investing in self-storage via Reit versus private equity?
The REITs are publicly traded stocks. The difference is generally you should expect a lower return because it's a safer investment, right? If you invest in public storage, for example, they have 2,300 properties. They're much lower risk that they are going to go belly up, right? They have very low leverage on their portfolio. If you invest with a Reliant, we'll have 53 properties at the end of July. But in return for that risk, our returns historically have very much outperformed the REITs. So, we can't share our return information with you on today's webinar, but if you reach out, we can send you some of our track record information to show that. And so, as an investor, if you're taking more risk, which you would be with a Reliant, you should be paid a premium for taking that risk. So I'd encourage you to take a peek at that information or ask for our track record. We'd be happy to send that out to you.
All right, thank you, Chris. Next question. Have any of your properties been on storage wars?
I think the answer is no. I don't know that for 100% sure. For those of you guys who don't know what storage wars is, basically storage is unique that when you don't pay your rent, we cut your lock. And each state's different, but we cut your lock and basically we put a lien on your goods in the unit and we can auction off your goods. So it's really the only asset class where your rent is collateralized by your stuff, right? So if you don't pay, the amount of bad debt we have in our portfolio is very small because if you don't pay, we're going to auction your goods and that's how we get our rent back. So Storage Wars is a reality TV show that makes it much more sexy than it is. Auctions are a pain for us, they're a pain for our tenants. But I think the answer to your question is no. I do not believe we have, but I'm going to reserve the right there because Storage War has been going on for a long time.
All right, thank you. Next question, is the demand for climate controlled units increasing? If so, who is using them? Pharma, question mark?
It's a broader question. It's market specific. So certainly the farther south we go, right? Let's say South Florida, we have a number of facilities in Naples. Well, most of the units there are climate controlled because the humidity is so high. If you don't use climate control, you run into mildew issues and those kinds of things. So it's market specific where climate is. In some of the larger markets, the primary markets where they're building multi-story stone and glass on the corner of Main and Main, those are usually all climate controlled facilities. As far as who's using them, it's all over the board. So pharma, meaning do they have drugs that need to be stored at a specific temperature? Yes. But residential customers are using them as well to make sure that their stuff stays safe, at a normal humidity. You're not building in, more mildew or mold or those types of things as well.
Okay, great. And then they have a follow-up question, and it says, who are the main long-term tenants? Businesses versus personal occupants?
Yeah, so generally our commercial tenants are staying about a year and a half. If you're looking at our average tenure of a residential tenant is about 13 months. Commercial tenant is just under 30. So a commercial tenant, think like a landscaper, and they're using this as their storage space for their equipment. They're generally a longer term renter than a residential tenant. So, it's market specific. Again, some markets are more heavily focused to residential, some have more commercial, and depending on where you are in that market.
Okay, great. Next question, how do we invest in Reliance SS offerings? Contact Chris, is that correct?
That's a good start. If you answer the poll question and send us an email or an email to me or answer the poll question, we'll start that process, get you some more information so you can begin your due diligence. Okay.
Next question, what are some of the biggest and most important due diligence items you consider?
Market. In the market, understanding that 1, 3, and 5 mile radius, really understanding the supply, who are the competitors, how much supply is there, what are the rates they're charging, and then how full are they, right? That's a great indicator of how the market looks. And it's not one specific metric. It's, our acquisitions team talks about building a story around the market. And that's really what we're trying to do. We're trying to take all these data points and tell a story around the market that we're going into and what's the reason we want to be there. And in the case study I gave you in Wilmington, that had a unique story. We feel like we're geographically positioned to take advantage of the population to the south of us. So we're trying to find those kinds of things that give us a competitive advantage in the space. So if I was to point to one thing, I would say it's really understanding the market that we're going into.
All right, thank you. Next question, what is the average length of stay for your customers?
I think we just touched on that, Mindy. For our residential, generally in that kind of 13-month range, and a commercial closer to 30 months.
Okay, great. How does the dollar amount of a facility's accounts receivable factor into your analysis of value?
I think what you're saying is how much unpaid rent is factoring into value. So that would be factored into NOI. The value on these properties is driven from net operating income, which is just total revenue minus total expenses, not including debt service. How the value is really derived in commercial real estate is applying a cap rate to NOI. So, that would be captured. If you had AR in there, it would be captured in how we came up with the NOI number. And generally, when we're buying a facility, we're going in and auditing the financials, auditing the rent rolls to make sure the revenues they're showing are real, that we can put our hands and tie them out to bank statements.
All right, next question. Does Reliant use leverage? Wouldn't that be a problem for IRA investors?
Yeah, so what you're talking about there is UBIT again. So I would say, yes, we do use leverage, generally between 65 and 70% loan to value, and it could create UBIT concerns that you should talk with your tax professional about.
All right. What is the strategy in selling a storage facility in 5 to 6 years?
It's generally when we think we can get to the values we're projecting, right? So when we work with investors, we say, hey, here's what we think your returns could be. And to get to those returns, the property has to be valued at a certain dollar amount. And that 5 to 6 year window is generally where we model that value. It could be longer, could be shorter, but generally that's where we're valuing or where we get the value to derive our investors' returns.
All right, thank you. All right, next question. How much capital is required to invest with Reliant?
Yeah, so the investment minimum is $50,000. Just remember that you do have to be an accredited investor to participate in our current fund.
All right, next question. Do you recommend setting up an LLC for your self-directed IRA? That is completely up to you. There are some advantages and disadvantages of going the LLC route. It's all relative to the individual investor, because what might be an advantage for one individual might be a disadvantage to another individual. So I recommend seeking advice from a licensed professional on what's the right option for you. We do have some really great content on our website, or if you want to shoot me an email, I have some information on LLCs versus investing directly through your SDIRA. So I'm more than happy to send over that information so that you can review that and kind of determine based on that information what might be the right option for you. All right, please talk about the process of investing with Reliant.
I would say start with us. We'll reach out via email, or if you want to fill out the poll, we'll have somebody reach out to you, and we can talk through what that process looks like. Generally, we'll provide the information on the current investment opportunity, and then you make a decision. Yes, I'd like to invest. We have an online portal that our investors go through the subscription process, and then we would work with Entrust on their process to allow funds to come from your IRA to our LLC or to our private placement.
All right, next question. Are you looking for investors to invest in specific deals or into a general fund?
So right now we're raising capital in a fund format. So think of it like a mutual fund of self-storage property. So the fund currently has 5 properties in it, another 3 scheduled to close in May, June, and July, so 1 in each month. So right now it's in a fund format, but we have done individual syndications, individual investments as well.
All right, next question. I may have missed this piece. When do you receive the returns, on a monthly or annual basis?
So in our individual projects, we're paying quarterly distributions. So we send out a quarterly distribution and a quarterly report to investors.
Okay. What is the population roughly of a tertiary market?
Yeah, there's no kind of hard and fast rules between primary, secondary, and tertiary. It could be small, 10,000 people in a 5-mile radius. It could be 20,000 people. But there's not like an absolute population metric we look for. Again, we're trying to build the story around that market, and even some other markets. I'm going to give you a quick example. We have a facility in like a resort town in the Highlands north of Atlanta, and it's a mountain area where many of the older, wealthier people in Atlanta go in the summertime to get into the higher elevation where it's cooler. On paper, no one lives there. I think there's like 5,000 people in a 5-mile radius, but that's because census data is tracking your primary residence, and all those people live in Atlanta. But if you look at the median home value in those markets, it's $500,000, which is a crazy number for a median value. And so what that means is you have all this money that's there, there's a lot of wealth, but on paper, it looks like there's no population. So again, it's not one thing, it's trying to build that story around why you want to be there.
All right, thank you. Next question. I understand accredited for me, but how can my SDIRA be an accredited investor?
The IRA is basically for us, if you're investing as an entity and all the members of the entity are accredited, then your entity is accredited.
All right, thank you. Is there a preferred return component as an investor in your funds?
There are, and I'd be happy to send you some more information on Fund 2 if you reach out via email or fill out the poll. We can send you how that structure works. Generally, we have an 8% preferred return as part of our structure, but I can certainly send that out to you after the fact.
All right, thank you. Next question. Are you able to disclose Reliance market cap? How much equity does 50,000 buy?
Well, the market cap, I'm not sure what you mean by market capitalization. I don't know if you're asking how much value the current portfolio is worth. How much equity does 50,000 buy depends solely on how much equity the fund raises in total. So we basically, what happens is when the fund closes, we send out a schedule of ownership that says, all right, Chris Benson invested 50 grand. Here's how much equity he has in the fund. So it really is depending on what the denominator is, which is the total amount of equity raised. We won't know that until we close the fund.
All right, next question. Who would buy back the shares if the investor wants to get out?
Great question. So no one. There is no secondary market for this, and this is illiquid money. So when investors invest with us, we talk about making sure that this is capital that you are comfortable having as illiquid, because there is no market to trade out. Your money is in there, and I hate to sound crass, but your money is in there until we say so. So until we sell the assets or close out the fund, your capital is in there. Now, we're returning it along the way, hopefully, if everything goes well, but there is no liquidation where you call us one day and say, hey, I invested $100,000, I'd like to get my 100,000 back. There's no market, there's no liquidity for that. And that's one of the downsides of these private placements. It truly is an illiquid investment.
All right, next question. What is average appreciation of these storage facilities, and how is the investor included in this portion of the investment?
Yeah, so this is one of those questions we can't really talk about on this webinar as far as returns and our historical performance. I'd be happy to send you some information on our firm and those 38 properties we've sold, give you a good sense of what that appreciation has looked like historically and what we project for the future, but we can't talk about that rate on our webinar today.
All right, what is the process if an investor invests in the fund and wants to exit the investment?
Yeah, I think we just talked about that, Mindy. This is one of those investments where you really have to be comfortable with the illiquidity of the investment. There isn't a liquidity event for you other than when we sell the portfolio. And again, you're getting distributions along the way, but that's why we project that 6-year hold. Our expectation is that people are along for the ride for those 6 years.
All right, thank you. Next question. What is the fundraise current goal?
50 million. We have 50 million in Fund 2. We're about 33 million raised and deployed thus far.
All right, next question. How much does a vacancy rate factor into value? Is it considered a plus, meaning opportunity to reduce vacancies, or a minus?
Well, in the value add component, it may be considered a plus because there's future value you can grow there. But it certainly gets factored into a purchase price when we're buying an asset. Because remember, again, it's based off of net operating income, how profitable a facility is. So if there's a lot of vacancy, there's probably a lower amount of profit, and vice versa. If it's full, there's probably more profit. So I would argue that that gets factored into the purchase price of the asset. But also we call that leaving meat on the bone for the next buyer, right? Someone else may be buying it saying, hey, I'd like to get this leased up, and they'll give you some of that future value in present value dollars. So it's always a game of, you take this thing and squeeze all the juice out of the lemon, and then it's just a stabilized asset, or do you leave a little meat on the bone for the next buyer?
All right, great. Next question. If the investment isn't liquid, how are IRA RMDs impacted? Can they be waived in such a case? So with RMDs, you have a couple of options. So you don't have to take an RMD from one specific account. You can take it from any account. But let's say that you have depleted all other retirement accounts, and now the only retirement account that you have left is holding Reliant self-storage investment. And as Chris mentioned, it is an illiquid investment. So your options at that point are pay the penalty, which is 50% of the RMD. So for example, let's say that your RMD for 2021 is $10,000. The penalty is pay $5,000 and you can keep the asset as is. The other option is doing an in-kind distribution, meaning that you're taking a portion of the RMD as an in-kind distribution, and now you personally own X percent and your IRA owns X percent. So that's your options for taking RMDs, taking it from another account, paying the penalty, or doing an in-kind distribution. And it looks like that concludes all of the questions in the Q&A box. And Andrew, I know you had a couple questions that were submitted directly to you, so I'll go ahead and turn it over to you to read those few questions that you received.
Great, thank you, Mindy. All right, Chris, this one's for you. Do your facilities still use traditional padlock, or have you started to convert to electronic digital locks? Is it worth upgrading traditional systems to new mechanisms?
Yeah, so the answer is, can we get an ROI from that investment? Obviously, you know, digital locks are more expensive, so you can basically just open the lock with your smartphone. You know, the other issue becomes, what does that technology, what happens when that technology breaks down? So generally, I think we've toyed with some smart locks, but 99% of the facilities have, you know, traditional disc locks or, you know, a key to lock.
Great, thank you. Next question, also for you. Do you require tenant insurance? Is this automatically added to the monthly charge, if so?
Yeah, so our leases do require tenant insurance on the goods in the facility. And so if you do not bring us a deck page, a declarations page showing your goods are automatically insured, you are signed up for tenant insurance and then canceled as soon as you bring a deck page in. So, you know, we require it as part of the lease so that your goods are protected. We obviously insure the building and the liability in case of fire, those kinds of things, but your goods inside the unit are up your responsibility to insure.
Thank you. Next question, also for you. Do you have any plans, rather Reliant, do you have any plans to move west, particularly to places like Arizona?
No, not right now. We're not that we're not looking in other states, but because we're vertically integrated, we want to be close to the facilities we currently own. There's some operational efficiencies around that we can take advantage of. So generally, we're going to stay in the Southeast or maybe expand kind of off the horizon of the states we're currently in. You know, as I mentioned, the Southeast, the Carolinas, Georgia, Florida, Carolina, Tennessee, Alabama. You know, we're looking at some properties in Virginia. You know, maybe to the Midwest, but we haven't looked in Arizona, Colorado seriously. If the right opportunity came, we would, but we got to make it make sense at the scale that we need to plug our operational team in.
Great, makes sense. Next question. I apologize if you covered this, but what cap rate do these sell at?
It depends. Cap rates have continued to compress in the asset class because there's been so much capital chasing these deals. You know, if you're in a large primary market in New York, let's say you're in Manhattan and you're selling a larger portfolio, you know, those cap rates can be low fours. Public Storage just bought a portfolio in the Mid-Atlantic, 48 properties, $2 billion transaction that traded at, arguably sub 4% cap rate. But, individual assets, in secondary, tertiary markets, probably in that 5 to 5.5 range, depends on the asset. But, I would say 5 to, low 5s.
Great, thank you. All right, next question. What is the default rate, and do you give renters 3 months to get caught up? Then if not, do you sell contents? Lastly, do you outsource the auction process?
Yeah, I think we talked about that with the storage wars comment. I would say that it's very state specific on what the rules are and how we handle those goods. And we work with a third party group who manages all of our AR issues so that we don't run afoul of the individual state laws. So bad debt is a very small part of our portfolio because we're able to auction off the goods and generally get a hold of any back rent due.
Great. All right, just a couple more here. Thank you very much for your time, Chris, and everyone who's stayed with us on the call. Do you always build new facilities?
No. Majority of what we're doing, as I talked about, is value add, where we're buying an existing facility and doing some sort of value add component to it. So it's an expansion or something along those lines. We do a little bit of ground up. There are some groups that do that exclusively.
All right, thank you. And last question here. Are investments subject to capital calls beyond the original investment?
Yeah, it's a great question. So our subscription documents essentially dictate capital calls in the following manner. So we have the right to ask you. You do not have the obligation to participate. So we have to ask you first. Hey, let's say there's a property that's going down the tubes and we need to raise some additional capital. We've never done this, but if we did, we have the right to bring it to you first. You have the right to hear it. You do not have the obligation to invest. If you don't want to do the capital call, you don't have to, but we retain the discretion to go out and raise additional capital if we choose to. And what that would do is dilute you from your investment position if we ever had to do that. So the answer to your question is no, you do not have to participate in a capital call if one was ever made.
Excellent, cool. Well, that brings me to the end of my questions. So Mindy, feel free to take us home.
Yeah, thank you, Andrew, very much for those remaining questions. I want to thank everyone for joining us today on the webinar. Chris, want to thank you for also co-hosting the webinar with us and sharing your expertise on self-storage. And again, anyone that wants additional information, please reach out to Chris or I directly, and we will be happy to answer any questions that you have.